Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Hi, Jim, and we've got a Friday this week, and we always get together and chat on Friday, and I look forward to it.
Bob, the U.S. 3-month Treasury bill, what's happening there?
It's declining, and it's one that I watched. Not many people watch the shorter rates, and they're important, but the thing is that there was a statement by the head of the Federal Reserve in Kansas City. Her last name is George. And here's the headline I got. She warns that if the Fed cuts the interest rate, that would lead to a bubble. That's theory. I've got interest rates going back and references to them, and there's a very simple observation. In a boom, interest rates go up. And then when a boom's been on for a long time like this one, people get concerned, like the orthodox side, they get concerned that, rising interest rates is awful. But it's not. As long as the rates are going up, it says the boom is on. So, for example, in 1929, which was the last great classical financial bubble, the 3-month Treasury bill went up to, I think it was 5% in May and June of 1929. And then it started down. And then the Federal Reserve, for some reason, raised its discount rate. That's what they used to call it back then. Now they call it Fed funds or something. But anyways, the Fed raised its discount rate in August of that year. And then this is what the establishment then says, it was that rate increase that caused the crash and that caused the depression, which is nonsense. But the Fed didn't cut its rate until October when the contraction was well underway. So with the Treasury bill turning down in that fateful June, July, that was signaling that the boom was over. And what I like to think, Jim, is that in a boom, there's demand for speculative funds, like right now money. And that somehow, they used to have the broker loans and things like that, overnight money, call money rates, all these sort of things. But ultimately it shows up in the Treasury bill rate. So it now, as of this week in the U.S., the 3-month Treasury bill has broken down. It set its high in March, and as of this week, it's now broken down. So it's setting the trend line. Then we keep track of the short rate in England with LIBOR, the London Interbank rate, the 3-month there. It set its high in December, and it broke down a month ago. And same with the 6-month bill in the U.S. It set its high in December and broke down. But I think the key one is the 3-month, and it is now breaking down. And in our books, Jim, that says that the boom is over. But here you have this woman, the central banker, with this theory that if the Fed cuts the rate, it would lead to a bubble. Well, we've been in a horrendously huge bubble. And then the other one, this is where the establishment is just out to lunch on interest rates because in September 2007, the boom was getting long in the tooth, getting mature, and there were some worries. There were strains in the credit markets. And so, but those who really believed in the theories, and some big names said that it was a sure thing. The Fed would have a nicely timed interest rate cut, and the boom would continue. But they don't know that empirically, short rates go up in the boom and down in the contraction. And the other irony, Jim, is that the more severe the bear market, the faster short rates decline. So in 1929, they eventually went down to effectively zero on the T-bill rate. And they did, following the boom of 2007, went to effectively zero and stuff like that. So it is fascinating that the establishment can hang up on a theory and that is just so wrong and then stay with it. So this poor central banker, pathetic central banker, is fearful to cut the rate because it'll lead to a bubble. Mm-hmm. So anyways, the T-bill rate is heading down, and this then suggests that the central bank in Canada and also the Federal Reserve System in the U.S. probably in a couple of months will then find a reason to cut its administered rate. And we'll take a moment on this one because the Treasury bill rate is a market rate of interest, and it trades all of the time. And while the interest rates are low, the changes are there all the time. Then you have, by the central bank, its administered rate. So it sets its rate at which it lends money to the commercial banking system. So here's another one. I think it's another classic, and the central bankers will again be seen to be wrong. And why they're wrong is because they've got theories that are based upon wishful thinking. And yes, it would be nice to keep a boom going. And their theory is, we can do that by lowering interest rates. But they don't know that in a contraction, market rates of interest go down. So, anyways, I think this week here, with the 3-month Treasury bill rate now heading down, having broken down, is very important.
We'll have more with Bob Hoye right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Media recognition from Bloomberg, Reuters, Recycling Trade Publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Bob Hoye. Bob, could the U.S. 3-month Treasury be going down because China is selling off their U.S. Treasuries in retaliation for Donald Trump's latest round of tariffs?
Oh, yeah. Then maybe they're selling that's the long bond. And maybe they might be, with their U.S. positions, shifting to shorter maturities. But I think it's the same old pattern. The bill rate reflects speculative demand for credit, and when speculation begins to diminish, demand for credit diminishes, and then the rate goes down. So But the long bond, U.S. long bond, the bond future has been acting quite well. But it's now up to some resistance, and maybe if the stock market slows down and some commodities get a little weaker, industrial commodities, and with this decline in the bill rate, you could get the long bond, long government Canada bonds or long treasuries rallying a little more in price. And then also, if things are slowing down, then the rally in lower grade stuff like junk and high yield, that then becomes precarious because those items need a strong economy for people to position them in. So we're watching for a change in the lower grade stuff as well. I think it's now, well, you know, when you have the disaster, the dismal Christmas and stock market so depressed and crude market depressed and junk bonds were down, and that was all part of our rebound idea where we have our friends of the rally, which would be industrial commodities and the yield curve and credit spreads. We figured all that would be positive out to at least March, and it has been. But now I think things are changing, Jim, and the low-grade stuff, which generates a good return when everybody likes it, and then it turns out to be a disaster when nobody likes it. So it would be time to take profits on junk bonds, high-yield bonds, anything, even preferred shares in there, that sort of stuff, because the market has been very carefree about risk, and risk is always there, but it's just that there are times when people don't pay any attention to it, and then there are times when people do pay attention to it. And, you know, we always work on seasonal influences, and a lot of the time they're very reliable. But one of the things that help you play the seasonals is to have very good technical tools. And you want to make sure that you can catch the, we had seasonal lows for crude oil and base metals and stuff like that in sort of for December, January, and the low was actually just before Christmas. So then you want to have the measures. So we had the lows coming in that dismal Christmas, and then you want to make sure that it is low. So this is where technical research comes in, and we had some very good oversold readings, and it was time to get positioned for the rebound. And so then you have, and we've discussed it often, the old saying, sell in May and go away. Well, that May window can be April, it can be May, it can be June or July, but it's an approximate thing. But if you have good technical research and you're getting overbought in April, May, June, or July, then you know when to position. So it works for us. And then you look at then what's ahead. And our base has been that this positive stuff could run into May or June, just roughly mid-year. And then in looking at the old seasonals, then you can get a transition after mid-year, say in August like last year, where all of a sudden the tone of the market changes, and then the vulnerability becomes evident, and then people go to sell, and the bids just are not there. We don't want to be gloomy, but because we were positive enough at Christmas time on the market being oversold enough to begin to take positions. And of late, you have the overall stock market is very pricey relative, and the one I like is do it relative to GDP or relative to the average wage. So that's a valuation that's high. We've had some very good momentum numbers, and you've also had some sentiment, which is the bullish opinion being written by guys who are doing market letters. So you got everything that you find usually near an important high, and we're getting that. So we think it's time to be building some liquidity. There's been some good stock moves. The other thing that's going on, Jim, are these new issues, as we used to call them, but they call them initial public offerings, or IPOs. And in the States, there's been a large number of those, and some of them very big, and some of them have worked out, and some of them, like Uber, have been a disaster from day one. So that is also the sign of a mature stock market when you get a lot of new issues coming out. So, gosh, I remember I was with a very good brokerage firm in 1968, and it was in Vancouver, and it was a very hot new issue market. And we're coming out with them, underwritings, and some of them would double on the opening. And so it was great. We were all making lots of money, loved it. And of course, when you're in a hot new issue market, the customers all want good positions in them, and because they're tight, you cut them back, and the allocations are not very much, and you try to give a few to some of the fund managers and a few here, and so everybody gets cut back. But then there would be very aggressive customers who would not only put an order in through the salesman they were dealing with at the brokerage I was with, but then they'd go to the trust companies and put in an order there, put in an order here, and everything else. And then you know what happened? Came along the issue that didn't sell. Well, this guy got filled everywhere in town. He probably ended up being filled on twice as much as he could handle, and then it was a disaster issue. So that is just a little bit of anecdotal folklore stuff from the market. And I think we're going to ask around and see if there's any in Vancouver, which is always a very active exchange, if there is a IPO new issue market going on locally, because we've got that experience from decades ago. So, Jim, there's a lot of stuff going on now that only happens close to important highs in the stock market.
We'll have more with Bob Hoye right after this.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, you were mentioning before we went on air that car sales in China have tanked. How bad is it?
Well, you know, they have incredible growth rates in China on normal economic numbers, and they've been way higher than anywhere else. So where in a more mature country, you can maybe get a 4% GDP would be good times, and then it can go minus. Whereas in China, it would be maybe plus 15%, and then in a recession it goes down to plus 5%. But this one about car sales, yeah, here it is. China car sales tanked 16.6% in April, falling for a record 11 months in a row. Now, hey, that's a trend change, and suggesting a contraction. So, the other one, here another one, China April industrial output cools, retail sales growth falls to a 16-year low. So there's something going on out there, and one has to monitor it and also understand what's going on. So headlines are full of the stuff about in the U.S. stock market, and the boom is now, I think, just a month at one of the longest in history. But the other way to look at it, as I mentioned, we've got these measures like momentum, sentiment, valuations are the only time you see those are close to an important high. So, and the other time you have seasonality, and you have important highs close to around May, in this window. And so then throughout history, you have had, if you're going to have an urge to liquidate positions, and often sadly it's forced liquidations by margin clerks, that's likely to happen in the fall of the year. And the oldest well-dated or well-written example was in Florence in northern Italy when the money market was there. It was an important money market in the 1300s. And the main thing that traded were mortgages. And suddenly there was a mortgage disaster, and there was an Italian economic historian, but his name is Cipolla, wrote an excellent book on it, full of details. And the 1347, I think it was, when it was very difficult, it was in the fall. Whereas, it was a contraction that went on for a few years with severe crises in the fall. So it would be nice to find out in Roman times when they would have crises in the mortgage markets, the financial markets, but how can you get the dates on them, whether it even exists or not? There are references to them. So there we are, Jim. The seasonality can be your friend, and then the other trick is you got to have the ability to measure how much enthusiasm there is when it's being friendly, and then when seasonality is not being friendly, you want to know when that's going to come too. And I'm painting a picture, I think, here of transition from, hey, this is good, to probably after August, oops, this is not so good. So, but who knows? All we can do is monitor it.
Bob, thank you so much for chatting with us.
Good to be with you, Jim, and we look forward to next week.
If you have any questions for Bob or any of our other guests, you can send them to info@howestreet.com. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of Howe Street Media Incorporated.